started here again. So real quick, this is for educational purposes only. For investment advice, please consult a licensed investment advisor. This is my picture slide, right? Okay. Chartered market technician. I don't have to explain that again. I'm not going to go over the quote. We went over it. So this is where I was before I realized you guys couldn't see anything. All right. So again, this is what I'm going to touch on. Position sizing and risk. I'm going to talk very quickly about price action, my learning curve. I'm going to talk about my process. Okay. This is basically the midsection here. And then I'm going to talk about some trade examples. All right. Because that's really where all the value is. All right. So again, I appreciate you, appreciate your patience here. All right. So let's move forward. Now, the risk parameter of the swing trade. All right, let me make sure I can see my questions here. And okay. All right. And my chat. Okay, those are the ones I want to see. All right, so let's talk about what a swing trade is. Okay, a position looking to capitalize on the broader trend of the market. You have to make sure that that's clear. You can't go into this with the idea that, you start out with a day trade and then you're going to turn it into a swing trade because it's not going your way. You cannot do that. Okay, so you start out, you're looking to capitalize on the broader trend of the market. Okay, so your time horizon is basically days to weeks, right? And the time frames that you should be looking at on your chart are basically 4-hour, 12-hour, daily, or weekly. No smaller than that, because the smaller you go, the more noise you're going to have to deal with. Now, when I talk about 4-hour, 12-hour, daily, weekly, we're talking about markets that are open all day, okay? They don't close like the stock market. If you're looking at a stock chart, because stocks are typically open only for 8 hours, then you have to, instead of a 4-hour or a 12-hour, you have to go to a 1-hour. That's particular to stocks because of the amount of data that you're organizing, okay? Risk is typically controlled with a stop loss order, as opposed to an investment that may use other techniques to manage risk. Stop loss orders aren't the only way to manage risk. They are just one way of many, but for a swing trade, that's typically the effective way, okay? Now, size. How much size should you take on a swing trade? It should be proportional to your account. Okay, a lot of people don't care to know this, but the average risk parameter, answering that question that I put earlier, 2% average risk parameter, which means for each swing trade you take, you're only going to risk 2% of your account. So we're going to talk about some specific numbers here in a minute, but that is a kind of a turnoff for a lot of people, because if you're only going to risk 2%, then what's reasonable? What's a reasonable profit target? Okay, and how much money can this translate into? That's all everyone's interested in, is how much money, how much money. We're going to talk about that. This is best used for markets, obviously, that trend regularly, okay, like Bitcoin, stocks, Forex, things like that. All right, so very quickly, I just want to compare swing trades versus investing in terms of risk. Okay, swing trades, basically you have smaller duration, right? Less risk. You're not in the market all the time. You're only in the market for brief periods. Compared to investing, you're in the market all the time. So you're exposed to the most risk. People don't want to know that, okay? Simple risk management with swing trades. You're just using a stop loss order. There's flexibility. You can take counter trend trades. So there are more opportunities, okay? You can basically utilize your leverage better. Fundamentals play a smaller role, so you don't have to be on top of the news and all that other nonsense if you understand what to look for, okay? All the information you need is on a chart, but it's not a lot of information. People think more is better. People think complexity has value. It does not, okay? You want to be able to make a trade decision or take a risk on the least amount of information possible, okay? Now, there's smaller returns, but you have more stability, meaning when you compare these things to investing, you're at the mercy of the market as an investor, all right? Especially if you have no investing plan or position sizing strategy, you're really at the mercy of the market. So that's why people, your typical investor does well when the market does well, and when the market turns to garbage, like we've been seeing in the recent year, everyone suffers because they're at the mercy of the market. You don't have to be, but that's the average investor behavior. You don't want to be that, okay? The herd mentality. You do not want to be part of that. You want to capitalize on it. As investors, especially amateur investors, they get caught up in that stuff all the time, okay? They don't know how to dollar cost average, which is one way to handle an investment versus a swing trade. All right, I'm not going to talk about all these points, but the point is investing has greater risk, okay? Because again, that's the basic point here, because you're always in the market, and if the market gets really hammered, you get really hammered. Let me show you a quick example. This is the NASDAQ 100, okay? Chart of the NASDAQ 100 from basically the December, January peak, and this goes back to like July, okay? This bullish market here, this bullish section, that's when everyone was having a party, everyone's making money, markets are easy, right? Everyone makes money, the market is your like ATM machine, and then when it turns, you're stuck in this as an investor, all right? And you're exposed to all of this risk. Of course, we know the market's gone lower since then, but the point is, this is what you're exposed to. What if you were investing up here at the highs because it looked safe, because some fake guru or some analyst told you, oh, you know, this market's going to go higher for blah, 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 and then you get stuck in this, okay? You don't want to get stuck in this. Now, as a swing trader, you have opportunities in this. So that's, you know, some contrast in terms of investing in swing trades. Now, let's talk quickly about position sizing and risk. Now, here's the thing. People want to say, oh, you know, I want to make, how much when you want to make each day? Well, I want to make $500. Oh, I want to make $1,000 or whatever, right? Well, if this is these numbers up here on the top of the table, this is how much money is in your account, okay? $1,000, $10,000, $100,000, okay? Over here on the y-axis here, you have potential profit, right, and risk. So if you only have $1,000, all right, these are realistic numbers, okay? 3% profit, $30. 2% risk, $20. That's on $1,000 account. If you go outside of this range, you're asking for trouble because it's now out of proportion. You can't take 5% or 10% risk on $1,000 account. If you're wrong 10 times, you wipe this out. But people, they go all the time. They go in, oh, I have $1,000 and I think I'm going to make $1,000 a day. That's a dream. And that dream, of course, is supported by a lot of fake gurus. Now, look, if you have a $10,000 account, these are realistic numbers. $300 profit is within reason. $200 loss, that's within reason. That is all you're looking at with a $10,000 account, not $3,000. Okay, that's not sustainable. Now, you want to make $3,000? You need $100,000 in your account. If you want to make this realistically, that's only 3%. 3%, and that's kind of optimistic, okay? Just so you know, especially if you're looking for a consistency. But I show this table because these are your proportional numbers. This is what to expect, okay? So if you want to make $3,000 in a swing trade, you're gonna have to have $100,000 in your account, okay? Otherwise, you're taking elevated risk. And you're going to be wrong at least 50% of the time, okay? So you can't sit there and say, well, I'm just, you know, I'm going to be right. You're not going to be right. You're going to be wrong at least half the time. This is a random game. This is a game of chance, not a game of skill. I'm not going to get into that here, but I have many rants about that, all right? So quick example. Profits and risks are proportional to account size. That's what this table represents. Okay, so a quick Bitcoin example. Right, at 20,000, right, 20,000 price Bitcoin, 0.25 Bitcoin is basically a $5,000 position, okay? You have a $5,000, a position valued at $5,000, all right? Now, if you have a 3,000 point move and you're risking 2,000 points, which is a typical swing trade, this is what you're looking at, okay? Potential $750 profit versus $500 of risk, okay? Now, again, this is assuming you have a position value of $5,000 or 0.25. Mistake people make here is they use a lot of leverage. They don't realize they're using leverage, and these numbers balloon okay? And if they balloon and you have a small account, you're gonna wipe out your account. Does that make sense? So how much is in your account? Now, at this reward risk, if you have $10,000, you're at 5% risk, okay, which is kind of high, all right? At $20,000, you're at 2.5% risk. This is near the risk parameter of the average 2%. Are you following me so far? Can I get a couple of yeses in the chat? I want to make sure you guys are listening. A couple of yeses. You guys following me? Let me see here. What's going on? Okay. You guys following me so far? You can press yes in the chat. This is like type message here. It says, I don't know what you guys can see exactly. Just give me a yes so I know. Otherwise, I feel like I'm talking to myself. Real quick, give me a yes. You following me? Bill, you there? Yeah, I have to know, I have to get some feedback. When I conduct these webinars, I ask for feedback. I want to make sure people are watching, people are listening, or that, you know, that everything is working properly. Okay? Any you guys following me so far? I don't see anything in the chat. I'm checking my questions. I don't see anything there either. Left side is off screen. Is that old? Let me see. Oh, that was at 8:06. Okay. We are not able to type in the chat box. Okay. You're not able to type in the chat box? That's interesting. Maybe I can turn that on somehow. Let me see real quick, because I want you guys, especially when you guys have to ask questions. Let me see here in the chat. I don't think I have that mute, unmute participants. Okay, I'm just looking at the controls here. I don't see anything that says that I have control over that. Maybe Rob, if you're listening, can you make it so that the participants can type in the chat? Because I'm not sure how to do that here. Okay. Okay, cool. Looking at it. Okay. All right. Okay, so anyway, all right, so you guys, so you guys are watching, you guys, let's move along here. So now, let's talk about this real quick. Probability versus reward risk, because probability is very important to swing trades, and it's something that people don't consider. They just look at, typically, a lot of people, they just look at some kind of setup, maybe it's something on the RSI or whatever, some kind of nonsense like that, and they have no sense of probability, and I want to give you some perspective on that right now. So let's assume that you're wrong half the time, which is random, okay? 50-50, it's like flipping a coin, but your reward risk is 1.5 to 1, meaning you risk $1, but you're looking to make $1.50 on every trade, okay? We're gonna compare that to, what if you had a 70% probability, okay? Meaning you'll be wrong 30% of the time, but right 70% of the time, and you have the same reward risk, okay? When you win $1.50, and when you lose $1, okay? Now, over a population of 100 trades, all right, if you're at a 50% probability, that means basically you win $75 and you lose $50, right? So you come out ahead by $25, assuming you're wrong half the time, but you're winning just a little more than you lose, right? Now, when we compare that to 70% probability, look at the outcome, right? You're coming out ahead $75. Now, here is the deceptive portion of this. What is the cost? People don't calculate that. A lot of people don't realize that there is a cost, especially when you trade with a broker that says it's commission free and all that other nonsense. There's no such thing as commission free. You're paying, it's just baked in. When you add the cost over 100 trades, it wipes this out. Okay, that cost basically contributes to a negative sloping equity curve. So this is an illusion. This profit is not real. which means you need to be better than random, even at a better reward risk, right? You need to be slightly better than random, because theoretically, you should be able to, this basically says you should be able to produce a profit simply by flipping a coin. But as we know, it does not work, right? Part of that is because of the cost. And that's one of the reasons why it's so hard to beat the market. And this is especially true on smaller time frames. People, these people that dream that they're going to be day traders, or that they think they're day traders. We have all these amateurs and all these wannabes, and they're fake, okay? And they fool themselves. They don't realize that they can't even beat their own cost. Always question that. What is the cost? So that's why you need to be able to stack probabilities in your favor. Can we achieve a 70% probability? Here's another thing that you may not know. The win rate, right, or the probability constantly changes with the environment. So some people may say, well, I have an 80% win rate. Just look at my 50 trades that I just made over the previous 6 months. If it was a really easy environment, sure, it's going to be a higher win rate. What happens when the environment gets harder? The win rate is going to change. Okay, so you have to keep that in mind. All right, I don't want to spend too much time on that, but those are some important factors I wanted to point out that people don't really consider when they are putting on swing trades. Now, let me ask you a question. Do you understand how risk and probabilities fit into swing trades after I've touched on them there? Do you better understand? Can you give me a yes? I can see now where you guys are typing stuff in. I think you can ask questions in the question box or something, because that's where I see the activity. So can you guys understand this now better? Okay, cool. Now I see you guys. All right, great, excellent. Now, let me touch on something else. When you learn about how to trade, or you learn about swing trades, or whatever it is, there are 4 areas that you need to have a strong grasp on. When you first come into this business, the first thing that everyone points you to is analytic, okay? Everywhere you go, every fake guru, analytic. They show you charts, they show you fundamentals. They make you think that there's some kind of secret in the charts, or this oscillator has some kind of special advantage, blah, 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 blah. That's all analytic, okay? But you need to be very aware of the academic side, the behavioral side, and the microstructure side. All right, what is that? What is that? Academic are things like efficient markets hypothesis. Bill, thank you for that comment, by the way, in the channel yesterday. I really appreciate that. Things like efficient markets hypothesis. So what is that? Things like random walk theory. Who cares, right? They don't help me make money, but they help you have a better grasp of what to expect. Efficient markets hypothesis basically argues that markets are random, and I'm a big proponent of that, but they're not always random, okay? If they were always random, we would not have a trend, okay? But markets are highly random, and we want to try to isolate the infrequent opportunities that exist that are less random. That's what we're looking for. Anyway, that comes from having a strong grasp of the academic side. Now, the behavioral side, what is that? That's things like the herd mentality, anchoring. There's all kinds of human behavior traits that are baked into price action. Traders get caught in positions because they're reacting to the obvious. Fear of missing out. People ask me questions all the time. Is Bitcoin at the bottom? I'm afraid I'm going to miss out and it's going to run away. That's all irrational. All right, I was giving an example yesterday during my student training. I had like a student meeting, and I gave an example, right? Just a human behavioral example, which had nothing to do with the markets. I'm going to say it real quick here, and then I'm going to move on. I was once watching a music video, but it wasn't a music video. It was a picture, okay, with music playing over it. And whoever put this video up on YouTube, they used a picture of a pretty girl, okay? It was just her face. This girl happened to be a former Victoria's Secret model, so she was beautiful, right? Now, what was the purpose of that? Obviously, to get clicks. You should have seen the clicks. Now, she was beautiful. So if you look at if you read the comments on the bottom of that, right, you should have seen the typical male behavior. All right, that type of behavior plays out in the markets. I'm using the picture of a beautiful girl because why? They all reacted the same way to her beauty. Couldn't imagine why they get so annoyed when everyone, treats them a certain way, right? Because they're so bored of that same reaction. Think about this. Here's where I compare it to the markets. When we have a move like we had in Bitcoin the other day, right, or yesterday, when it basically went to 20,500 or 21,000, that movement, they're only focused on that. That's going to elicit a certain type of behavior. Our goal as a swing trader is to capitalize on that behavior, not be part of it. Understand something. As a retail trader, your role as retail traders, all of us, is to get fleeced by the market. Fleeced, not to profit. We are the profit opportunities, okay? As retail traders, we need to recognize that. By educating yourself beyond the analytic, you begin to separate yourself from the herd mentality. You need to be separate from it. You cannot behave like everyone else. Everyone else's behavior becomes the opportunity for professional traders and the industry. Why do you think Forex dealers trade against their customers? Anyway, so what is price action? Let's touch on this real quick. How am I doing with time? Okay, not too bad. This is how I define price action. Actionable chart information that is observed and evaluated from price itself, rather than a derivative of price, okay? So basically, it's pure price, like what? Chart patterns are price action. Support and resistance, that's pure price, all right? There's no oscillator involved in that. Candlestick patterns, you can't get any closer to price action than candlestick patterns. You also have price structure, like trends. What is a trend? Higher low, higher high, lower low, right? Those are trends. Trend lines, channels, those all come straight from price. There's no smoothing involved, okay? So that is price action. And these techniques or these methods, whatever you want to call these here, are things that I use to come up with swing trade ideas and take swing trades. So let's take a quick look at some real examples here of price structure, trend lines, and price patterns. Now, let me pull up my chart. Let's see if I can do this without messing up the whole thing here, and you guys can see what's going on. So you guys should be able to see my chart, right? Let me make sure. Yeah, I put my chart in the screen here. This is Bitcoin. All right, so price structure, right? Let's talk about each item here. Price structure, trend lines, and price patterns. So I have all that going on here on this chart. This is a simple Bitcoin chart. Now, price structure, lower highs, lower lows. Let's see, what is that? Where are they? Can you see them? I'm going to point them out here. So we have a lower high right here, right? Relative to these highs. That's a lower high, okay? Lower low. This is a lower low, all right? We have then another lower high. You see that? We have another lower high over here, another lower high over here. Currently, we may be establishing another lower high, but lower high relative to what? To this high? No, it's a little higher than that, right? But relative to highs that are meaningful, this zone, right? If this establishes a lower high, I will consider that a lower high. While novices, oh, it's a higher high, the market's changing. Nothing has changed. If this is a lower high, lower lows are still likely. This market is still respecting resistance levels in general. Does that make sense? That's price structure, okay? Now, let's talk about trend lines. Well, trend lines, that's pretty obvious. I like to use horizontal trend lines. You know, people like to draw like the regular trend line. They like to connect the high to a high, right? And you have a slope. Okay, that's cool, but they break all the time and they can be very confusing. I like horizontal because basically I'm just pointing out support and resistance levels, okay? And that's what all you see on my charts, lines, horizontal lines. That's all I'm interested in, levels, okay? Which is part of the structure that I teach. So, and price patterns. So price patterns, what's a price pattern? Double top, double bottom. Here's a double bottom right here, okay? Here is a double top over here. Those are patterns. Actually, it's a failed high over here, failed high over here. Failed high is basically a variation of a double top. So double tops, double bottoms, you want to get a little more fancy and you want to talk about head and shoulders and all that other stuff. Yeah, you can get into that. I'm not a big fan of all those classic patterns because they get too complicated. And a lot of times they appear randomly as well, and they can cause a lot of confusion if you lose sight of the context, okay? So, but an immediate pattern like a double bottom or a double top, again, you want to see it in context, but there's a lot of value in that information if you understand what to anticipate. All that comes from behavior, okay? Human behavior. Basically, I like to think of the market, okay, the entire market, all financial markets are nothing more than a derivative of human behavior. Begins with human behavior. People don't even bother with that. They look at the charts, RSI, blah, blah, blah. Human behavior. The markets are a derivative of that. Does that make sense? Think about that. Okay. And guys, and by the way, if you have any questions as I'm running through this, please feel free to ask because I can see now where you're typing them. Okay. Okay. So yeah, I'm just checking back here, making sure this is cool. All right, cool. All right, so again, here's just another quote. What gives me more value is not what's in the course more than what is. Basically, in this environment, I find it hard to gauge useful versus useless information. Most information that we come across as retail traders is useless. Mark, pointing only to useful information allows me to focus on what really matters. Bart said that. He was another student of mine. And, again, less is more. That's the key point there. You need to be able to make a decision on the least amount of information possible. And you want to try to make the smallest amount of money possible for the smallest amount of risk. People don't like when I say that. People want to hear, well, you want to make the most amount of money possible for the least amount of risk. You want to make the smallest amount of money possible. Why? Because there's a greater probability that you're going to capture that. But when greed steps in, who wants small? You need to make big money like the big traders, like the bankers. That's all an illusion. That's all nonsense, okay? Don't be Captain Obvious. All right, how long do you think it takes to achieve some consistency? This is a very interesting question. All right, and someone gave me a very interesting answer recently. Anyone want to answer this question? How long do you think it takes? Bill, don't answer. Bill knows all the answers, so I have to tell him to be quiet. I appreciate you, Bill, trying to participate, but please, let the new people answer. I'm just picking on him. How long do you think it takes to achieve some consistency? Anyone want to answer that? Okay, there's really no wrong answer, but it's not an opinion. But okay. Anyone want to answer that? Quick answer. How long do you think it takes? Whatever you think. I'm not gonna yell at you. If you say, oh, I only think it takes a couple of weeks. How long do you think? Give me one answer, one person answer. Anyone want to answer that? Several years. Okay. How come that's interesting. Let me do this here. Okay. Good question. Good answer, Zoltan. Several years. What's several? Couple of years? 5 years? The reason why I asked this question, all right, and let's get into it here, is very quickly, I want to touch on my learning curve. Okay. I'm not going to read all this stuff, but I want to point out that basically when I started out in this game in 1999, I believed that this game was skill-based, and I was able to make money as a day trader, but I had no idea exactly how I was making that money, okay? When things had changed in the market and the advantages that I had, which I had not realized that I had at the time, were no longer in play, then that's when I had to deal with the random market, and this was no longer skill-based, okay? It was now based on chance. I had no idea that this change took place. All I knew was I could not make money anymore. Okay, so going for a number of years here, let's see, it was about 10 years. All right, now I've been learning, but not making money. I knew something was wrong, but I could not figure out what it was. Okay, it took me 15 years to figure out what the problem was. And that was after getting hired at SMB Capital as an educator. Okay, still not really making money. But I was very well versed. I had my CMT. I understood markets, but I still could not put my finger on why consistency was so elusive. Okay, and I bring this up because I want to explain to you what I learned. All right, markets are efficient and highly random. this was a big moment. You know, everyone thinks in this game, and a lot of fake gurus like to bring this idea up that you're going to have some kind of light bulb go off. There's going to be some kind of aha moment. Ah, now I'm going to make millions of dollars now that I understand. No. Okay. When you figure out how to reach consistency, you're not going to be making millions of dollars, because again, you have to face the risk. But one of the main things that I realized was markets are highly random, which means no one knows anything. It also means all the nonsense that's peddled to us, okay, like oscillators and moving averages and this special strategy and that special blah, 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 it's all nonsense, because none of it gives us any type of advantage. If you don't have an advantage, you cannot beat the market most of the time, okay? Especially with conventional methods. So that means that anyone that talks, oh, look at my RSI, they're just pulling your leg. They're just trying to get your attention and sell you something, because there's no advantage. What's an advantage? Inside information. That's an advantage. If I was friends with Jerome Powell and he personally told me what his plans were for the Federal Reserve and no one else knew those plans, I would have inside information. If I placed trades on that, it would be illegal, okay? And I would get arrested. That's called insider trade. That's insider trades, right? It's illegal, but not in the Bitcoin world, it's not. But in the regular conventional stock world, it is illegal. Anyway, that's who has an advantage. So what do we do when we don't have an advantage? Anyway, we'll talk about that. But this is mostly a game of chance, not skill. And if there is a skill, it's not what you think it is. Everyone thinks that the skill is, oh, I have to be good at charts. I have to be good at, you know, this moving average or this oscillator, or it's all, you're just wasting your time, okay? You can get the same result by flipping a coin. That is all you need to do if you're going to use charts, right? Like in the conventional way. So the skill is not where you think it is. Analytics and trade strategy are not the same process, okay? Analytics, you basically come up with the idea, you're defining risk, right? You're trying to gauge probability. And then when you put on the trade, a different process has to take over, because you're constantly adjusting now. Okay, and what are you adjusting? Your risk constantly. All right, you need a process to isolate the higher probability opportunities or the higher quality opportunities. A process, a step-by-step process, a routine, something that you can do the same every time. That is what helps you become objective. So you don't sit there and say, oh, well, this kind of looks good. I feel this. Wrong. Okay, you should say, okay, the criteria is met. There's no longer a reason for me to be out of this trade. The risk is acceptable. I can put on this trade, and the market has confirmed I can get in. Okay, it still may not work out even after all that, but that right there filters out a lot of would-be stop-outs, something that people don't appreciate. Okay, especially beginners that think they're going to get rich doing this. Advantage can be derived from market psychology. And that's why I brought up behavioral before. Market psychology, all right? You need to capitalize on the mistakes of others. That is how a trader makes money. Don't think, though, you're taking money out of the banker's pocket. You're not taking money out of the banker's pocket, okay? Now, let me introduce you here to my analytics process. These are the 6 steps that I use to come up with a swing trade. All right, this is where my swing trade ideas come from. So first we talk about, right, trends across time horizons. Then we have levels, that's step 2. Step 3 is proportions, basically measurements, right? We use the fibs for that. Forecasting techniques like Elliott wave, right, can be helpful. Step 5, patterns, double tops, double bottoms. Step 6, candlesticks, and some combinations which allow us to have some form of confirmation. I use these 6 steps in this order every time. Now, just so you know, less is more, right? And you can actually, if you really want to just isolate this to like only the most important, you can actually skip step 3 and step 4 and only have step 1, 2, 5, and 6. And if you want to get even tighter than that, it can just be 1, 2, and 6. That's all you need. Less is more. You can come up with reasonable trade ideas, okay, that are in line with market expectations. Of course, you have to have some context behind that. You can't look at a chart in isolation, but this is all you need. And this is what I teach people, to extract information from charts. This is the information, all right? Now, what is context? Let me talk about this, and then I'm gonna go into a Q&A section here momentarily. But actually, you know what? Let me just go back a slide there. Before I get into that next slide, I just want to address one thing. So Zoltan said that it can take several years. Okay, now realistically, I just want to point out it took me 15 years. So it was a little more than several, and I thought that I had some kind of market knowledge. Now, of course, I went the trial and error route, all right, which I do not suggest. It helps immensely if you have someone that knows that's proven, that knows what they're doing, showing you, the shortcuts and basically helping you shorten that learning curve. In that scenario, if you basically have some sort of quality guidance, because there's a lot of fakes out there that pretend, you're looking at 3 to 5 years, okay? 3 to 5 years is realistic, all right? 3 to 5 years, not 3 to 5 months. I have to repeat that because people don't want to hear it. I'm honest about this stuff, and that's why no one likes me, and no one follows me. I have a couple of, Bill follows me, but not too many people want to hear what I have to say because it's not pleasant, and it doesn't fit into the dream and the hope infused world out there. Everything in the financial industry, blah, 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 on the retail side has hope infused into it. It's fake, okay? All these traders that, oh, YouTube, there's so many traders that make money. They don't make money. Most traders don't make money, all right? So there's a lot of ways to fake it. We're in the most deceptive business in the world. Please understand that. It's amazing to me to see a fake go out there and have 500,000 followers and the guy's a complete phony, but he sells a good dream. They're salesmen. They're very good at marketing, okay? And selling that dream and that hope. And it's an emotional appeal. So of course it's attractive, okay? And I'm the opposite of that, and that's why no one follows me. Anyway, let's talk about context real quick, and then I'm gonna have to skip some slides because I really have to keep this at an hour. So what is context? Market relevant factors that do not offer actionable value, but provide a way to gauge probability or risk. These factors are usually not obvious, so they're typically not going to be on your chart. They're invisible, right? Oscillators do not provide context. They can help confirm it. Now you have fundamental context and you have technical context. Let me just talk about fundamental very quickly. This is a very important slide that no fake guru will talk about because they don't know about this, okay? This is something I learned as a chartered market technician, and it's basically, it describes, or it makes a picture, I can't think of words today. It describes the seasonality of money, all right? Just like, farmers plant their seeds and grow their crops based on a season, based on the weather, right? Money also has a similar situation, and this is called the Pring-Turner economic cycle. It's the business cycle, and this is about a 4 to 5 year span of time. Now, this curve that you're looking at is GDP, okay? It's a function of GDP, and when GDP contracts or we have a recession, you're going to see money flow a certain way. And the money is represented by bonds, stocks, and commodities, things like gold, silver, stuff like that. Now, it's in this order: bonds, then stocks, then commodities. So when we have a recession, what typically happens? The Federal Reserve steps in, which they haven't done yet, and they start lowering interest rates, right? Okay, when interest rates go lower, what happens to bond prices, right? If rates are going lower, bond prices go higher to reflect lower rates, right? So bond prices start to rise first, and then stocks follow, and then eventually, everything follows. And then when we have a peak, right? again, the bond market starts to sell off first. We saw this back in December when the bond market here in the US was actually had peaked and had been selling off, which means rates were quietly rising. No one was paying attention, especially the stock market. The stock market was making new high after new high after new high. About 5 or 6 months after the bonds had peaked, the stock market peaked. That was February, okay, January, February, okay, and now you see where we are now. So based on where this is the ideal curve, by the way, it doesn't always play out exactly like this, but the point is this can help you get some sort of context. I use this theory right here to basically guide my expectations as far as like Bitcoin. People ask, oh, is Bitcoin, when is Bitcoin gonna rally? Well, bonds need to show a significant change first, and they're trying to right now, but they haven't proven anything yet. When rates stop rising, then that's the beginning, okay? And then maybe we'll start getting the free money, will start coming back into the market. But bonds need to turn around before we can expect something like Bitcoin to turn around, because Bitcoin is highly speculative and is dependent on easy monetary policy. Do you see how that fits in? That's fundamental context. That's something that's invisible. That's something that most people will not consider because they're too busy focusing on the one green candle at the moment. Does that make sense? All right, let's move along here. So here, I'm gonna just spend a couple minutes. This is an old Bitcoin chart. What I wanna do is I'm gonna show you an example on the most current chart, okay? My real-time chart here, because I wanna show you 2 examples. So first thing I wanna show you real quick as far as trade examples and how I use all this information that I just presented to you. All right, so first of all, just the other day, I put a swing trade idea out short, okay? And I put that short out over here. It was right there, okay, here. Like short, that wasn't a good idea. Well, now we can see that. But when I put that short out, I basically was anticipating the break of the support. That was a short right into the support, and it was based on the criteria I just mentioned. Now, here's the thing with that. Yeah, it got stopped out for 2,000 points. The stop was up here, okay? And it went straight to the stop. Of course, after the fact, oh, that was, you know, that was a dumb move. Well, here's the thing. This trade actually offered the opportunity to get out earlier, and that was this pin bar. Again, so tying all this together, yeah, a trade idea developed and it got conflicted. There was an opportunity to get out. Now, I basically said I would give it a chance because of the economic environment, right? Because rates haven't changed, nothing has changed, and this is most likely relatively weak compared to the S&P. I wrote about that. That was wrong, but hey, I'm not always going to be right. But the conservative trader, if you saw this, you could have been like, well, I don't like the bullish pin bar. That's a bullish reversal off of a support. How do we know that's support? Well, if you went through the 6 steps, you know that this is a support, okay? So that was an early exit, and yes, it would have been a loss still, but much smaller than 2,000 points, okay? Now, going back, should I have mentioned to everyone, get out on that conflicted signal? Well, looking back, it's easy for me to say, yeah, sure, I should have said that. But you know what? I was trying to let this position play out based on those other factors. It's not always going to work, all right? Keep that in mind, but the risk was still limited, right? At 2,000 points, because that's where the resistance was. Now, let me point this out, because again, I'm tight on time. So instead of showing you a second trade example, what I want to show you is the next trade idea that I'm considering, and that is what? Going short again. Wow, why would you go short? This thing is going straight up, it's vertical. Why would you go short that? Because I'm going to show you why. Let's talk about the 6 steps real quick. The trend is still generally bearish, okay? I'm talking about bigger picture. I'm not talking about this little move. That little move is not the trend. That's just a momentum reversal, okay? It carries very little weight. The economic environment has not changed, okay? So basically, we're still in a rising rate environment. We still have a lot of bearish factors floating around, okay? So this thing is very suspect as far as long. The long side is very limited based on those factors, okay? Now, it can change, and if it changes, I'm all about adjusting, okay? But right now, this is a resistance level. In fact, it's a failed high resistance, okay, which is a pattern. So again, step one is trend, right? So we've determined trend is generally bearish. We're looking at the bigger picture. Step two, levels, right? We have a resistance level right here. So this is a place where we can anticipate selling activity. Step three, proportions, and then Elliott wave. I'm not going to get into all this here. I said we can skip those, but there we can find some extra information in there to help confirm or give us some more confidence about the level if we want to find that. But let's skip that for now. Okay, patterns, failed high. That's a pattern. It's like a double top. Now, confirmation, I don't have it yet, right? Candlesticks, I have a potential inside bar. We have the whole day before this closes. If this closes and takes out the low, that's my pattern confirmation, okay? That's my candlestick confirmation, and that would call for another short. Now, whether that short works out or not is another story, but my risk is going to be a little tighter on that, because of this movement. If this thing is going to continue higher, I don't want to get caught. I don't want to lose another 2,000 pips and 2,000 points in a move if this wants to continue higher. But my point is this. I'm following the structure. I'm following what the market is telling me. I don't have any opinion. A lot of people see this and they become Captain Obvious. And right away they think, oh, this thing's going to go to 30K. I mean, look at that. This thing's going to go to 30K. They said that here. They said that back here. They said that over here too. Okay, don't have opinions. Okay, so with that, I'm gonna have to basically cut this. I'm gonna have to basically stop the presentation portion now. Let's just, I'm not going to get into the RSI. I'd like to, but I can't. So let me just mention this, and then I'm going to do a quick Q&A. So where to begin? Don't expect to make money right away if you're new. All right, that's realistic. You may make money randomly, but don't think you have this figured out just because you have a couple of green trades. Your priority should be to protect capital, and that's it. Protect capital. All right. Construct and test your analytics process. Avoid smaller time frames for now. I talk about smaller time frames like in my streams that I've been doing every day, but you need to be experienced first before you're going to attempt those. Everyone starts out, they think they're going to be a day trader and they think they're going to make all this money. Please don't go that route. It's the hardest route and the easiest route to lose all your money. Okay, test your strategies, right, and apply these tests from your analytics, not your feelings or any other random stuff. Have the steps. I just laid out 6 steps for you, okay? Your objective overall is to try to operate multiple strategies across time frames. Now that can get complicated, but that should be your overarching goal, meaning, you're not gonna just swing trade, and that's not gonna be like, oh, that's all I'm gonna do. You're going to eventually be able to apply these concepts to day trades, to investments, right? And you want to have all these things working together because there may be no opportunities on the swing trade side. Meanwhile, there's a lot more opportunities on the day trade side, and there's going to be less frequent but higher quality opportunities on the investment side. You want to be able to capitalize on all of those using similar concepts, but each category is going to have its own specific nuances. All right, back to my training. R. Christopher says the most valuable part of the training is the algorithm of the 6 steps. All right, it's amazing how it builds technical analysis for more technical analysis more adequate to the market. Okay, and reveals opportunities. It's market centric. Okay, it's not egocentric. Now, quick, my training program. If you're not familiar with it, I'm going to talk about it now real quick. And by the way, while I'm talking about this, if you have questions, now would be a good time to ask. Okay, so my program sells for $299. Okay, it's not ridiculously expensive, but I know it's not cheap for some people. This is what it entails, right? You get 8 weeks of access. There are 8 assignments. I want to show you what that looks like real quick. Okay, so if you go to my website, marcpremarkets.com, and you click on this over here, the courses, this is my training program. Okay, 6 steps to objective price action analysis. If you click on that, it takes you to this page here and it shows you the curriculum. Okay, this is the curriculum. And I want to point this out real quick. Like for example, module 1, there are 8 modules, okay? 8 modules overall. The modules are released every other day. Very important to understand that. Basically you get the information, you have a day to work with it, okay? And then the next day, right? Every other day, the next module becomes available, right? It becomes accessible. Each module has some videos in it. They're short. It's to the point, okay? I don't waste time. There's no fluff in here. But each module also has an assignment, okay? The assignment. That's really the key factor of this training program. And when the next module becomes available, the first thing you get is a review of that assignment, a review. So you'll have an idea is if you've done your assignment correct or not. You have an answer key, basically. That's the main part of the program. That's where the learning takes place. Yes, the videos are important. They help prepare you for the assignment, but you have to do the assignments if you want to get value from the program, okay? So that's quickly how it works. Now, you also, there's basically 90 minutes of video instruction. You can do this at your own pace, and you don't have to start this, on any kind of particular schedule. In the 8 weeks, all the modules are just going to be released over 16 days, and then you just work with them when you're available. It doesn't take long to watch the videos, maybe 10 minutes, okay, something like that. 90 minutes altogether. Now, once you complete the program, I'm bringing people over to the private student server on Discord. I'm about to open that up to all students, all right? But right now I'm doing meetings monthly. I had my first meeting yesterday, right, for students. So if you're so that's the program. Now let me point out something here real quick too. If that's, I have a special, but here let me go back. Yeah, there it is. Okay, so here, let me go over this and I'll mention the 8-cap thing. If you want my program cheaper, okay, you can save 35%. I'm doing this for 12 students. It's for today. I'll give some people a chance if you want to do it by tomorrow. You go to my website, okay? I'm going to type it in the chat here, okay? Let me just type it in. You can go to, I'm going to give you a coupon, okay, if you're interested. So you can get my program cheaper. All right, so that's, here it is. Okay, you go to this page right here, okay? And you can get this coupon, right? So for $194, you're getting all that, plus my one-on-one, that's not really one-on-one, my small group monthly reviews. So you can ask me questions, right? It was very nice because it's a small group setting, and you can ask me very specific questions about the material, about the assignments, and all that other stuff. Okay, and it's almost like one-on-one training. So it's very helpful. Now is the time to learn. Don't wait until the market is at the peak like everyone else. Learn while the market is hard so that when the market improves, you are in a position to capitalize on that with confidence. Otherwise, you're never going to be sure, and you can be, I don't know, the market's moved up. By the time I buy, it's going to pull back. You're going to be a mess. Okay, trust me when I tell you. Now, if you are not an 8-cap customer, okay, hold on, let me go back. If you are not an 8-cap customer and you are non-US, you can get my training for free, all right? If you open an account with 8-cap, of course, the sponsor of this webinar here, and you deposit $500, all right, and you trade one standard lot, you can get my training for free if you meet those requirements. All right, this is the link you have to go to. In fact, I'll type that in here as well. Okay, hold on. So that's this link right here. Go there. Again, non-US, and you can't be from a sanctioned country either. So if you're like from Russia, they're not going to open your account. But any country that's not sanctioned, you have this opportunity. So please take advantage of this, because we're not going to always do this. 8-cap is willing to basically pay for the enrollment fee on your behalf. Okay, so please take advantage of that. Otherwise, do I have any questions? Any questions?